You know, sometimes the infinite banking concept doesn't work the way you want it to. Sometimes lightning hits the same spot twice. Unfortunately, I certainly can't say the same thing for this guy. In today's episode, what we're going to do is we're going to look at a few different infinite banking nightmares that can happen to you. See, there's about a 1 out of 15,000 chance that you're going to get hit by lightning. Now, when it comes to the infinite banking concept, the likelihood of something going wrong is super low. It's almost always a win-win situation, and that sounds a little bit too good to be true. But like everything in life, there are those rare occasions where things go wrong. Today, I want to show you 5 different scenarios that absolutely scare the out of some people. And I also want to give you some actionable steps to prevent any of these problems from happening to you. Speaking of statistics, there's about a 50% chance that you aren't subscribed to my channel. Now, that's a problem. So what are you waiting for? Right now, hit that subscribe button. You don't want to get hit by lightning, right? So let's minimize the chance of you actually not subscribing. So click that subscribe button, and then right up top, there's this little bell. Smash that bell, and you'll be notified every time I put out new content. Let's dive in. Nightmare number 1. You lost your income stream and you can't make your premium deposits. Oh man, that's a nightmare. That might be worse than getting struck by lightning. You started this great policy to be used for the infinite banking concept, and now you don't have the income that you thought you were going to fund those premium deposits you set up. Let's hit the solution on how this doesn't ever become a problem for you. When you design your policy, or when we design your policy is a better way of saying that, we will design it around whatever your specifications are. You might say to us, Chris, I want the ability to put up to $10,000 into my policy. Great. I'll build your policy to hold 10,000 or 10 million or whatever amount you want. The amount that I build the policy for is the maximum amount you can put into the policy. If it's 10,000, 10 million, $1,000 a month, whatever that amount is, that's the most you can put in. But let's just say something happens and you lose your job, your income stream changes, or anything that I mentioned in that nightmare. You have the ability to reduce those premium deposits anywhere between 60 and as much as 90%. That's right. So if you were doing 10,000, your bare minimum would probably be about $4,000. Now, it could even be as low as $1,000. Depending on how we design your policy, we can design it to have as much flexibility as you want. Now, if that's still too much, we can always reduce your death benefit on the policy. Now, there's a little bit more work that comes into this, but if we reduce death benefit, we could even bring it lower, but you're never going to get that death benefit back. You see, if all you do is float within that range we give you, 10,000 to 4,000, 10,000 to 1,000, if it's designed that way, you're always going to have that flexibility to go back to the max. And in some scenarios, you can even make up the premium deposits you didn't do during that little unforeseen period of time in your life. Moving on, let's talk about nightmare number 2. You took a loan from your policy with the intentions of investing that money, and the deal that you invested in flopped, whatever that might be. And now you can't pay that loan back. Oh my goodness gracious. Lightning does strike twice. Whew! Okay, so what's the solution? I was kidding. This isn't really a big problem. This will happen. So if you take a loan from your policy and you invested in your real estate deal, but for some reason the real estate deal you invested in, it flopped. You didn't make any money. Matter of fact, you lost money. And now you're like,
oh my God, I can't pay the loan back.
Great. Somewhere along the line, you probably have heard me say that the insurance company will never actually ask for the loan back. Now, the loan interest, they will ask for that. Every single year on your policy anniversary, you'll get a premium statement that will show what the loan interest is due. You'll have to make that. Now, sometimes when you invest in a real estate deal, or maybe you bought a stock that didn't do well, whatever the deal is that flopped, these things happen, and it's usually a learning lesson. But the policy loan that you took does not need to be paid back. Now, it should, because if you don't pay the loan back, you're going to hurt the future performance of your policy. Of course, there's that much less money never making it back into your banking system, so it's not a good thing. But this exact scenario happened. I had a deal that I used my policies to fund. The deal went like 2 years. Everything that could have went wrong did go wrong. I would say the deal was a flop, but in the end, it actually ended up working out. We rented the deal, and I used some of the rental to cover the interest on the loan. See, I never ever did not pay the loan interest, and I would suggest, to avoid an absolute nightmare, always pay the loan interest on the policy loans. But this deal, after I rented it out, so we're talking almost 3 years went by, we did end up putting it on the market and selling the property. And when we sold it, yes, we took a loss, but I took whatever money that there was that came back and I repaid what I could on the loan. Now, although it wasn't 100%, I paid almost all of the loan back. And then I just made that money up on future deals. Now, whether this happens to you or you face this nightmare, I don't know. But if it does happen, just know that it's not the end of the world. It's a learning lesson. And the money you borrowed, thank God it wasn't from a credit card. Thank God it wasn't from somebody else's bank that you have to pay it back. Otherwise, they take the property. If a deal flops, learn from it. Find a way to make future deals catch you back up. The one thing I will stress, don't ever intentionally steal from your bank. You remember that deal I said where I lost money? When I actually sold that property, I did put that money back in the policy as a loan repayment, but it wasn't all the money that I took out. And it's okay. And I never, ever missed my loan interest payments, because why would I? The insurance company's paying me interest and dividends on all of the money, even though I took it out and I used it in this flop of a deal. So because they're paying me the interest in the dividends already, they're already paying for the loan interest if you really think about it. So when I paid the loan interest payment one time per year, I was kind of just using money the insurance company gave me anyway. You get it? Oh, and that brings me to nightmare number 3. So remember we were talking about that guy that got struck by lightning? Poor guy. Well, he actually lived. But when he lived, he might not live the same life he was prior. So that brings me to this nightmare. Let's just say you got hit with a chronic illness or a terminal illness, one that you're not going to make it through, like the guy that got struck by lightning. I don't know whether to call that chronic or terminal, but getting struck by lightning cannot be a good thing. But if you got struck with chronic or terminal illness and you thought that was going to affect your policy, I got some good news for you. All the policies we design have living benefits. So what does that mean? Well, when you take the policy out, I know you're taking it out to create a banking system, a private banking system, which is kind of what we teach, right? We want to use the policy with the infinite banking concept, the process. But if you came down with a chronic illness, let's just talk about that one first, and you could not work anymore. So you're nowhere, because of the illness, there's no way you can go back to work. So therefore your income falls to basically just disability income or whatever other incomes you have coming in. So here's the good news. All the policies have a chronic illness rider. What does that mean? Well, in most cases, that means that the insurance company will not require you to make premium deposits on the policy anymore. Now, you got to check with the agent to make sure that your policy qualifies for that, but most of them do. So when you are chronically ill and you prove that to the insurance company with doctor's records and letters from doctors, that policy will then go on a premium offset, meaning there's no more premium dollars that can go into the policy. But here's the good thing. What it also does is it basically allows you to access all or some of your death benefit. Yes, you're still living, but you're living with a chronic illness. So the insurance company will advance portions or sometimes all of the death benefit. That's right, you haven't died yet, but they're going to let you use your death benefit while you're living because you triggered one of the living benefits called chronic illness. Now that's pretty cool, right? You don't even need to die to access the death benefit. But let's go on to the next one. And this one's a little bit tough to talk about, but terminal illness. You come down with an illness that's going to unfortunately end your days on earth. You'll eventually graduate. And we've all heard these stories. A lot of times, certain cancers, they say, oh, you've got 4 years to live, you got 4 months to live, whatever it is. That's a terminal illness where there really is no getting better from it, at least not in normal scenario. So a rider on the policy is a terminal illness rider. What does it do? The same thing we just talked about. It typically will allow your policy to go on premium offset. Check with your agent on this one as well. So you won't have any future premium dollars to put into the policy, but then you'll be able to access the death benefit. And usually a terminal illness will allow you to access a high percentage, if not all, of your death benefit while you're living. Because how the insurance company looks at it is they know you're going to die someday. They know we're all going to die someday, because that's what life insurance companies do. Now, here you are told by a doctor or medical professional that you have X amount of time to live, terminal illness. So therefore the insurance company says, hey, why not allow that client, that policy holder, to access that death benefit while they're living and enjoy their final years, months, weeks, whatever it is, with their family, and go and use some of that death benefit to do it. Now, in some scenarios, the terminal illness or the chronic illness could also pay for different care. Okay, maybe you need at-home care, or maybe you need Medicare or Medicaid or Medicare or whatever it is. Whatever you need, you could use the death benefit or a portion of it to help offset those costs in the event of one of those two illnesses. So, nightmare, yes, but it certainly doesn't hurt as bad as getting struck by lightning. Not once, not twice, but 3 times, since that's nightmare number 3. Nightmare number 4. Now, this nightmare, I don't even think it's a nightmare, but somebody said that this could be really bad if they did this. But let me explain it to you, and then I'll explain the solution, and I'll tell you how the nightmare is not really a nightmare. It'd be kind of like dreaming that you're having a nightmare, and then you wake up and you really weren't having a nightmare. That was just your life. Anyway, you designed your policy to perform a certain way, but then you changed your mind. So what do I mean by this? You design your policy for a specific problem you're trying to solve. Let's just say pay down credit card debt. And you design it so that it's most effective for paying down those credit card debts. But then all of a sudden something happens and you change your mind on what your goal is. And now instead of paying down credit card debt, what you want to do is you want to start becoming a private lender, because the credit card debt just paid itself off somehow. So just because you changed your mind doesn't mean that that policy and the need that it was designed for should change. Matter of fact, that policy will work just fine either way. Just fine for paying off debts, just fine for buying cars. It'll work just fine for lending money out or buying real estate. Here's where it would become problematic. You designed your policy to hold a certain amount of money, like I mentioned in nightmare number 1, let's call it 10 grand. But then the next year you want to put 20 grand in because you got more income. Now we can't do that, because your policy was designed to hold only $10,000 by IRS rules called the MEC 7 pay. So we can't take your policy and have it go from $10,000 a year in premium deposits to $20,000 a year in premium deposits just because your circumstances changed. We can go lower, but we can't go higher. So that could potentially be a problem. But you know what? It's an easy solution. Start your second branch office, or third or fourth, or whatever number you're on. And what do I mean by branch office? Another policy. You want to put more money into the policy, you start another policy. Great, I do that. I just started my 10th, yes, that's right, my 10th policy. Why? Because life changed. I had more income that I wanted to put through my banking system, so I had to keep opening additional policies. So no matter what changes, no matter what you designed it to do, there's always a solution for the next step. Oh, and that brings us to the final nightmare, nightmare number 5. Now, I'm gonna take myself and my team out of the equation, but let's just say you set up a policy with another insurance agent, you know, your broke-ass brother-in-law, and they said this was being set up to do the infinite banking concept. But once you look at it, you say, you know what? That doesn't seem to work the way that it should. Or let's just say somebody, God forbid this happens, somebody sets you up with one of those IULs, those index universal life policies, and they say that that's going to work better for the infinite banking concept. Not true at all, but let's just say that happened. What could you do? So there are a couple solutions. Number 1, let's just play the good solution. Let's say your broke-ass brother-in-law set you up with a whole life insurance policy, but it wasn't specially designed to do anything with the infinite banking concept. It's just a regular off-the-shelf whole life, because that broke-ass brother-in-law didn't watch my videos, yes, my videos, didn't learn what the infinite banking concept was, just heard that you wanted to buy whole life for this thing called IBC, which they had no idea. All they heard was commission.
Don't get cheap on me.
So they set you up with a regular, plain, vanilla box, off-the-shelf, whole life policy, which basically probably would have zero cash value year 1, zero cash value year 2, and very little year 3. So what is the solution? Well, the solution would be keep that policy, because in the future, much further in the future, after year 10 or so, that policy will still be pretty effective. I hate replacing whole life policies because I know how beneficial they are in the later years. Now, yes, did your brother-in-law do you a disservice? Absolutely, because you won't have access to the money immediately in the first 30 days like what we do. But it still might not be a bad policy. There are other solutions that we can talk about one-on-one. Maybe it would make sense to replace that one, but very rarely does that make sense. But let's go to the other part of this nightmare that I mentioned, that swear word, in life, IULs.
Language.
Let's say your agent, God forbid it's your brother-in-law, because you're not going to be friends anymore, but let's just say they set you up with an IUL. Now, I know there's different ways to build IULs, and I have seen them designed the right way. However, very rarely or ever, let me just put it, never, will an IUL work for the infinite banking concept as a whole life will. It just doesn't. There's a lot of reasons, you know, and I could have the lazy cash here explain all those reasons, but I'll just give you just a few. There's a rising cost of insurance. So every year that policy's in existence, it gets more expensive. And every single IUL has a surrender charge, meaning in the first couple years, sometimes 7 years, sometimes 5, there's a surrender charge, meaning your cash value is not the amount you can actually use. It's a surrender amount of the cash value. So it's always going to be less. And with the infinite banking concept, we want access to as much of the money as we can early so we can send that money to go out and work a second time. So if that's the scenario, we can review the Index Universal Life. In some cases, we can do a 1035 exchange, bring the policy's values over to a properly designed and engineered whole life, and in that case, get you off on the right, the right path that you initially intended to be on. I see this stuff happen all the time. Hopefully it's not going to happen to you, but if it does, book a call with us and we'll figure out what the best scenario moving forward is. So now that I've provided you with the proper bedtime remedies for those infinite banking nightmares that you've been going through, you can finally get some beauty sleep. Gosh, we all need some sleep. The only one here who gets sleep is this guy right here, because he's lazy. But I hope you enjoyed this episode. And again, please like this video right here and subscribe to this channel. And while you're at it, click that little bell, because we do content like this for free. And all I ever ask you for is to click one of those couple buttons, subscribe, like, or the little bell. And also, if you're thinking about using the infinite banking, give some of those haters hugs in the comments, right? So if you're thinking about doing the infinite banking concept and you're already doing it, there's haters out there that don't think this will ever work. Throw them a hug. I always say haters need hugs too. I love reading when my members and subscribers down in the comments put nice things or try to educate other haters who just haven't come around yet. So thank you to all of you putting the comments on this. And until next time, fellas, go out there, be good bankers, be honest bankers. And folks, speaking of nightmares, check this video out. The credit card crisis is here. That video shows you the real nightmare. Give it a whirl. And until next time, good morning, good evening, and good night.